He left a $240,000 salary to Freelance. 6 months later, he had more money than he had ever made at the job and more stress than he had ever experienced in his life. That is not a success story or a cautionary tale. It is a description of Level 1 Freelance Quant. And Level 1 does not last. This is the map of what comes after Level 1, not the highlight reel, the actual progression, from the chaos of no structure to the control of a system that runs independently of how you are feeling on any given Tuesday. There are levels here, the financial levels everyone talks about, and the identity levels that nobody labels but that determine whether the financial levels stick. You cannot understand one without the other. 743. That is the number in your checking account at 2:17 in the morning after a client delays payment for the 4th consecutive month and your quarterly taxes are due in 11 days. You are not broke, not technically. The money exists. It is in the invoice that has not been paid. But the number in the account does not care about the invoice. It is just a number, and it does not lie. This is where Level 1 starts, not with success, with that number. If you want to understand how this progression actually works, from the 743 at 2 a.m. to the system that does not require you to be at your best every single day to function, subscribe. Because this is not a freelancing tips video. This is a map of how the financial levels of independent work intersect with the identity shifts that have to happen for each level to hold. Level 1, the call. You left the salary for a specific reason. Maybe it was the ceiling, the sense that the org chart had a fixed limit and you had already hit it. Maybe it was the specific work, that 90% of what you did at the desk was not the part that lit something up and you wanted to do the other 10% full time. Maybe it was the math, that your skills had a higher market value per hour than any employer was going to pay you, while also having you fill out timesheets and attend the Tuesday afternoon all hands. The reason matters later. For now, you left, and leaving created a specific kind of exposure that employment had hidden from you. Employment is, among other things, a system that absorbs complexity on your behalf. Your employer handles payroll tax withholding. They negotiate benefits. They create predictable income on a predictable schedule. They give you something to push against, a structure, even an uncomfortable one. When you leave, all of that complexity lands on you. Not gradually, at once. The first month of Level 1 usually feels like freedom. The second month starts to reveal the infrastructure you were taking for granted. By month 3, you have learned the word estimated quarterly taxes in a new and visceral way. You have learned that the self-employment tax, the portion that your employer was paying on your behalf, now comes entirely out of your gross income. You have learned that more per hour does not automatically mean more per year, when it takes real time to find the next engagement and the time between engagements produces no income. Before my first 100,000 as an independent, I thought the transition from employee to freelancer was primarily a financial calculation. Rate times hours minus expenses. I was right about the calculation and completely wrong about everything the calculation does not capture. Level 2. The infrastructure problem. You have clients, you have income. You have enough work that the income is consistent enough to rely on. The money is real. The problem is that you built the client side of the business before you built the financial infrastructure of the business. And the financial infrastructure of an independent practice has specific components that need to exist before the income gets real enough to matter. Here is what infrastructure means in practice. A business entity, an LLC at minimum, possibly an S-Corp election depending on your income level and the specific tax math of your situation. That separates your business income from your personal finances and potentially changes how your self-employment tax calculates. A system for quarterly estimated payments that is not reactively calculated every 3 months, but proactively structured at the beginning of each year based on your projected income. A retirement account, a SEP IRA, or solo 401k that allows you to defer significantly more income than a W-2 employee can, and simultaneously reduces your taxable income in the year of the contribution. A high-yield savings account, or equivalent, that holds 4 to 6 months of operating expenses as a genuine buffer, not a theoretical one. None of these are complicated to set up. They are each a 4 to 6 hour project done once. But they require a specific mindset shift to prioritize. Because when you are in level 1, the urgent things are client acquisition and billing and delivery. The infrastructure feels like it can wait until things slow down. Things do not slow down. And so the infrastructure does not get built until something forces it. What usually forces it is a tax bill that arrives in April that is larger than expected. Not because you did anything wrong, because the withholding system that managed this complexity for you at the employer is gone. And the self-employment tax plus federal plus state minus whatever deductions you knew to take did not add up the way the paycheck comparison suggested. The shift happens when you stop treating the financial infrastructure as a task and start treating it as the foundation that determines whether everything else can scale. And there is a specific moment where this shift happens for most people. It is not gradual. It is a Tuesday afternoon where you sit down to respond to a client email and instead find yourself calculating how much you owe in quarterly taxes, discovering that the number is larger than your current checking account balance, realizing that your savings are technically available but feel wrong to touch, and understanding in one concrete moment that you have been operating without a financial buffer because you assumed the income would always be there in time. That Tuesday afternoon is expensive, but it is also the moment that builds the infrastructure, because after it, you build the infrastructure. Every independent I know who has a working financial system has a specific Tuesday afternoon in their past that they point to. Level 3 then. The pricing problem. The pricing problem. You solve the infrastructure problem. You are billing. You have a system. And then you look at your actual effective hourly rate. Not what you charge, but what you earn per hour of time committed to the business, including administration, business development, the time between engagements, and the number is lower than you thought it would be. This is where most independents plateau, not because they cannot do the work, because they have underpriced the work relative to the actual cost of delivering it at the level of quality their best clients expect. The pricing problem has a specific shape. You set your initial rate by reference, what you were making as an employee, what you heard other people in your space were charging, what the first client agreed to pay without negotiation. That rate feels good when you get it. Then it becomes the anchor. Every subsequent conversation starts from that anchor. And the anchor is almost always too low relative to where the work eventually prices correctly. The correct rate for a skilled independent is the rate that reflects not just the hours of delivery, but the years of expertise those hours represent, the opportunity cost of not taking other work during that engagement, the overhead of running an independent operation, and a margin that makes the business sustainable over time rather than just profitable in any given month. That calculation almost always produces a number higher than the anchor. And raising from the anchor to the correct rate is one of the more psychologically difficult transitions in independent work, because it requires believing that the market will support the higher number before you have tested it. Level 4. The control problem. And this is the level most people who run successful practices never fully solve. You are making good money, more than the salary, consistently. Clients are good. Work is interesting. The infrastructure is built. Quarterly taxes are not a surprise anymore. And you are still working at the same intensity you were at level 1. Because the capacity to take time off, real time off, where the income does not drop, requires a different kind of structure than the freelance structure you built to get here. Here's the thing, though. The freelance model and the independent business model look similar from the outside. They feel completely different from the inside. In the freelance model, income is directly tied to your active presence. When you work, you earn. When you do not work, you do not earn. The math is simple and the constraint is obvious. The independent business model, which is where level 4 lives, includes income streams or structures that generate revenue without requiring your active participation in every transaction. Productized services with fixed scope, fixed price delivery. Recurring revenue from clients on retainer, where the engagement is structured rather than open-ended. Passive income from investments that have been building throughout the earlier levels. Intellectual property that generates licensing or royalty income. Not all of these are available or relevant to every type of quant work. But the principle is the same. At some point, the ceiling of the freelance model becomes visible, and the question is whether you build through it or stay below it. I know exactly what that ceiling feels like. You are doing well by any reasonable standard, and you are also acutely aware that if you took 3 months off, the income would drop significantly. And that awareness shapes every decision about rates, about client selection, about how much capacity to hold, about whether to say no to something. The ceiling was always there. You just did not know where it was until you got close enough to touch it. Back to 743, the number at 2:17 in the morning during the client payment delay. That number is level 1. It is not the destination. It is the beginning of a map that most people either never see clearly or see and conclude that the instability is inherent to independent work rather than specific to the level they are at. The map goes chaos, where the income is real but the infrastructure does not exist yet. Infrastructure, where the foundation gets built and the financial operation stops being reactive. Pricing, where the rate reflects the actual cost of delivery at the quality level that matters. Control, where some portion of the income decouples from active participation. Most people spend years at the chaos level, not because they lack the skills to progress, but because the transition to each subsequent level requires a decision that feels uncomfortable in the moment. The LLC formation feels bureaucratic when you have clients waiting. The SEP IRA contribution feels premature when the income is still inconsistent. The pricing conversation feels risky when you finally have clients who are paying. The productized service feels like a constraint when the custom work is what you know. Each transition has a cost that is paid upfront and a return that arrives later. Every level, without exception. The balance was 743. It always starts near there, not because that specific amount is universal, but because what it represents is. The exposure of the moment when the structure you relied on is gone, and the structure you are building has not arrived yet. That gap is not a problem to avoid. It is the gap you live through on the way to the next level. They compound. The decisions compound. The infrastructure compounds. The income compounds. The distance between level 1 and level 4 compounds. Money measures decisions, not intentions. That is the part that stays with you. This is not financial advice. It is a story about decisions, the kind that compound, the kind that do not, and the kind you make before you know which one it is.